Thank you to Trevor and team for the invite, and I trust that all of you have had a productive and insightful session today. Before I begin, I would like to say a huge thank you to all of you for your support. Many of you have been clients for over a decade and a half, and it's quite amazing to think we were then a relatively small asset manager with less than 10 billion rands of assets. Today, we are responsible for 400 billion rand of clients' assets. It's a responsibility that we take seriously. We're very appreciative of the support that you have given us along that journey. Trevor's asked me to talk a little bit now about the future, around how we're thinking about big trends, and I've identified 5 big trends that we're thinking about, that we're trying to position our business, and that I think is worth you thinking about how you position your business to thrive and succeed in the future. So the first big trend is around a concept called lower for longer. And really that is a realization that we are operating in an extremely new environment of very low interest rates. I love this graph, which really just shows from 1300, so it's certainly one of the longest graphs I've ever looked at, is a structural decline in real interest rates to a level where we're sitting with negative real interest rates, and in many ways are part of a large experiment. But there are a few things that we do know. Clearly from this graph, you can see that the risk-free rate is at a very expensive historical levels. And with all assets priced off that, most assets are sitting in historically expensive levels. What this means is that one needs to consider the implications for future returns. One needs to consider the implications that this has pushed investors towards chasing yields because they're not earning anything in cash, and the potential implications that this has on volatility. So what can you do as an advisor? I think the most important thing to do is to make sure that one is having conversations and real conversations with one's clients now. And we partnered with Silicon Valley organization, which had helped top advisors in the United States to have those conversations. And the first tool we've got is called the Big Picture Chart. And that looks back at returns since 1920 and really is a good conversation starter to put things like market downturns in perspective. That would have been fantastic in March last year to have had this, to have put those in context. It also explains the importance of investing in growth assets if one's trying to outperform inflation, and identifies the key principle of diversification. The second tool is the Big Picture app. And that's a dynamic, easy to use tool. Again, we've used data going back over 1,000 months and incorporated South African data into it. And this allows investors and clients to really understand the decisions they're making and the trade-offs of those decisions. So for example, they can quickly understand the impact of that it's unsustainable to take a 10% withdrawal rate from their retirement savings, or to understand that the decision to retire at 55 instead of 60 or 63 doesn't really make sense, or that the risk of being invested too conservatively and staying in cash can massively impact their probability of a successful outcome. So we have these tools available for you. If you haven't seen them, I suggest you chat to your Nedgroup Investments representative. I think they are very valuable tools to have meaningful conversations. The second big trend is around technology. And I love this Bill Gates quote, where he talks around how we overestimate the amount of change that is going to happen in the short term, but underestimate the amount of change that's likely to happen over the long term. And I've seen that absolutely happen. If you just think, none of us could have thought how much smartphones would have impacted us just 10 years ago. I think when we look back in 2030, we'll be amazed at the impact of artificial intelligence and machine learning. But technology is a very complex topic, and the way that we look at it is we break it down into 3 components. The first is around efficiency. So this is all around where technology and one can automate processes that are good for your business. So that means it saves you money, it saves you time, you're more accurate, but also good for the client in that improves the client experience. And I'll call these the no-brainers, they're real win-wins. And a good example in our business is around automating transactions. 3 or 4 years ago, all our transactions were manual. So someone would send in an email or something similar. We estimated that used to take about 30 minutes. That is 7 pages, a new application form, we needed FICA, we needed your ID and proof of address, etc. That's now all become a really slick, no paper, no signatures required, and is able to perform in under 3 minutes. And that's a real win. And I think in your business, you need to be trying to identify those transactions and those processes that you can automate that achieve a win-win scenario. The second area of technology is a bit more complex, and it's what I term client experience. Often this requires quite significant investment without the obvious revenue uplift. But at the same time, another way to look at this is if you don't make the investment, it's what I call the taxi owner conundrum. So if you were a taxi owner, you could have seen Uber coming. It didn't matter if you strike, which many taxi owners across the globe did. If Uber was cheaper, more convenient, more secure, you effectively just lost business. And so again, I think you need to be thinking around the technology that you need to either invest in or partner with players who are investing in, who provide a great client experience, because our clients are looking to be able to deal with us when they want, how they want, and where they want. And the third area is around, that's linked to technology, is around the area of cybersecurity. And our industry, because it involves large sums of money, is extremely prone and attractive to cyber criminals. And I think with all of us working from home, that's increased the risk of threat. Again, cyber criminals will aim at where your weakest link is. So I think it's important to understand that and also to be aware of the cyber strength of your partners. But a particular area that I'd focus on is making sure that your staff are well trained and educated on managing the risks. The third big trend is around fees. We all know the importance of fees and of the compounding effect of it on returns, especially in a low return environment. And if we just look at the different components in the value chain, the first is asset management. And this is quite a complex chart, but I think a very interesting and illustrative one. Across the horizontal axis, one has net flows in deciles. Has investment performance in terms from worst to best. And in terms of the vertical axis, one sees pricing from the lowest down to the highest. The light blue bubbles represent outflows. The dark blue bubbles represent inflows, and the size of the bubble shows the size of the in or outflow. What's very startling from this is the very small number of funds that are actually having inflows, and they're only the best performing. So whatever we say, money follows where the past performance has been. It's very clear from this. But also you can see that the larger bubbles tend to be the lower cost funds. So without a doubt, a trend that we've seen historically and which we expect to continue is a decrease in the economic profit within the asset management industry, both through a reduction in fee levels, but also what we've seen is where the flows are going. Similarly, with platform fees, we think advisors and clients are going to challenge that as technological innovation happens, and we're going to see a reduction in platform fees. If I move to advisor fees, I think it was a very interesting research done by Morningstar where they asked advisors and clients 18 questions and then compared where the biggest difference in their answers were. And the two biggest areas where there were differences were, can you help me maximize my returns? Where investors gave very high returns, but advisors gave low emphasis, didn't think that they would say that that was important. And secondly, help me stay in control of my emotions, again, where investors there gave low, but advisors thought they would value that highly. Now, to me, this combination is a real disaster for advisors because clients believe you're adding value in area where you have quite low control and don't think you're adding value in the area where you actually do have control and add huge amounts of value. And I think this is a serious communication gap, a serious perception issue and something that needs to be managed. A number of players have done some great research on the value that good advisors provide. So Morningstar, Russell, Vanguard, etc. And they've called this advisors alpha. And what you can see is that the real value is added in things such as coaching clients' behavior, making sure they don't avoid switching, they don't panic, that they stick to their plan, being aware of costs, rebalancing timelessly, being tax efficient, and many of the things that the multi-manager looks to assist you so that you can focus on doing these things. The fourth big area is in the area of globalization, and our previous finance minister spoke about our little Aloe not doing very well, and certainly with all the recent unrest, I think that's just accelerated the trend that we had been experiencing for some years around scandals, corruption, the state of our finances. But I think that the really key thing here is to realize that an increasing number of your clients are immigrating. This is from First National Bank, and you can see a higher percentage of clients immigrating. And if they're not actually immigrating, that they are financially immigrating or their children are immigrating. And so it's absolutely vital that you have a plan on how you are going to deal with this and how you're going to offer a competitive international offering. This is something that we identified about 12 years ago, and I think we launched our international best of breed offering and multi-managing offering to combine what we think is the best of both worlds. We search the world for exceptional managers who we think have an edge in their area of expertise, and that's a huge competitive advantage not to be limited to one investment house. Offer our clients access to that via both a feeder and a feeder fund and via offshore UCITS in a well-regulated area, and then be able to service you from South Africa. And as a consequence, we've been very proud of how we've grown that business from tenfold, from $500 million to $5 billion, and very proud also of the performance that we have delivered. The fifth and final trend is around the changing demand of stakeholders. And really I split this up into two key areas, one being the stakeholder being regulators, and we've just all in our industry now, it seems for a long period, and I think it will continue, seen a huge amount of significant and costly regulation. And I know you've talked about a bit about this today, but the one area that I would, I think has been under-considered and will have a significant impact on both the industry and on the advice industry is that of retirement reform and of the default legislation. And I think it's worthy of serious consideration. We've looked at developing solutions that can both help trustees in a cost-effective and scalable manner, but also link that to advice. And if you'd like to find more about that, please do chat to us. And the other area, and again, this has increased with COVID, is people saying that just making money is not enough, and the whole concept of purposeful capitalism. And we certainly feel that we're fortunate to be part of Nedbank, who we feel has played a leading and authentic role in sustainability for decades. We've actually just celebrating our 30th year of partnership with the Worldwide Fund. We've been the largest financer of renewable energy in Africa. We've been a level 1 BE contributor for the past 5 years. We're one of the largest contributors to the Youth Employment Scheme, and have played, I think, a very leading role during the COVID crisis, and certainly makes me proud to be part of Nedbank. But specifically in our area, an area that's receiving a lot of attention is responsible investing. And again, I think you've heard about this in the previous few days. But this is a very complex but important issue, and we're trying to address it in a few ways. The first is to make sure that we are very transparent and disclose. So on our website, any investor in any of our funds can see exactly how we voted on your behalf, where we voted against the resolution, why we did that. We've also tried to increase education, both of ourselves and our clients and our managers, via a range of webinars. And we've held some really good ones, both on shareholder activism and diversity this year. And finally, we've completed probably the most comprehensive research in South Africa on the status of it amongst the investment management industry. And that's been very useful both to get a benchmark, to identify best practice, and to try to improve the levels. And again, if you haven't read the report, it's available on our website, and I really encourage you to do that. So in summary, there are 5 big trends that we've identified: lower for longer, an increased impact of technology, a focus on fees across the value chain, globalisation with South Africans looking to externalise their wealth, and increasing stakeholder demands both from the regulator and society. And hopefully I've been able to identify some actions and what we're doing to try to help you to be able to address those and thrive in the future. Thank you very much.